What's up, everyone? Welcome back to my world of stocks. Now, a lot of you probably know about Jim Simons. He's a world famous mathematician and billionaire investor who's had a lot of success running his giant hedge fund called Renaissance Technologies, where he implemented his own expertise in mathematics and statistics using quantitative models to determine the best possible investments. And it's all really interesting stuff that helped them actually become the second largest technical hedge fund in the entire world, only behind Ray Dalio's Bridgewater at over $100 billion of assets under management. Well, something that we like to do on this channel is cover the biggest stocks that the wealthiest investors in the world are buying. So in today's video, we'll be running through Simon's 5 largest purchases from the last quarter, which is the most up-to-date information that we get. And he spent several billions of dollars on these, so they were very large purchases, but I'll give you my own opinion on each one of these. And of course, as always, I'll even rank them from best to worst too, based on that opinion. So make sure you hit the like button, subscribe if you haven't already. It really helps keep my channel alive, and it means a lot to me. I hope that you appreciate all the hard work that goes into these videos, and I hope you're enjoying them. But thank you everyone for all your support. It means so much to me. But let's not waste any more time. Let's go ahead and jump straight into this list. All right, now we'll be sorting these purchases from smallest to largest weight in the portfolio, with purchase number 1 being the ultra popular coffee retailer known as Starbucks, ticker symbol SBUX, which Simons seemingly unloaded the boat on, increasing his position by over 750% last quarter, bringing it up to over $400 million worth in the portfolio. Now, Starbucks is an interesting one because, well, for one, they're extremely large, controlling over 40% of the ready-to-drink coffee market in America. That's far and away at the top. And they've also done a great job of also expanding internationally too, where they have been really trying to find even more growth opportunities, opening up more than 8,000 new stores just in the past 5 years, of which the vast majority of those were outside of the United States. And yet the stock price has actually taken a big hit over the past year or so. Now, it's still positive in the past 5 years by over 27%, but from the top, Starbucks stock is currently down almost 30%, which helped raise their dividend yield at least up to the second highest level in history at just over 2.5%. You add on the solid growth metrics of about a double-digit 5-year growth rate, a reasonable payout ratio, and a double-digit growth history, and that really turns into a pretty compelling option there for dividend growth-minded investors. But why then has the stock been falling? Well, there's been a number of recent issues that we could look at, probably the biggest of which being employee dissatisfaction here in America, where they've been unionizing throughout the country and at complete odds with the founder and former CEO of the company, Howard Schultz, who ultimately stepped down about a year ago and has now been replaced with the former CCO of PepsiCo. Well, we'll have to wait and see just how successful management ultimately is at solving these various company-specific issues, but at the same time, Starbucks has also been facing a rise in competition from both large national chains that also serve coffee, like McDonald's and other things like that, as well as smaller kind of hole-in-the-wall or specialty coffee shops, which have really exploded in popularity recently for their higher quality brews, especially among younger crowds that enjoy that more kind of unique kind of experience as opposed to the more kind of cookie cutter, like copy and paste nationwide chain style of Starbucks. Don't get me wrong though, I actually like that convenience from Starbucks as they're really easy to find. The app remembers all of my favorite orders. There's always plenty of parking at their locations, and some of them even have drive-thrus or are located inside of Targets or other shopping centers, making it super easy to grab a drink whenever I want it. But I can also appreciate the charm and uniqueness of smaller coffee shops too, so it really just kind of comes down to personal preference, and it's a bit of a mixed bag for me personally. Regardless though, I can't argue with Starbucks' success over the years, although profits have been a little stagnant, but over the next 5 years, EPS is expected to actually rise by a much higher rate of over 16% a year, which is pretty good. And overall, it's just hard to envision Starbucks really ever going under when they're already so incredibly large and dominant, and again, they're just so convenient. Personally though, the only reason why I've never purchased the stock myself is because the valuation has always been too high for me. I mean, even now, after falling by so much, you're still talking about a PE ratio that is around 40% higher than the sector. The PEG is a lot better because of the expected future growth, but given how much the stock market has risen this past year to, around an all-time high, I'm just not as willing to buy into such highly valued stocks these days as maybe I once was. Unless they're doing something really innovative or exciting, then maybe I would consider it. But, this is a coffee retailer that we're talking about here, so that doesn't really qualify for that. But because of that, it's really just kind of a middle of the road type of stock for me, and I'm going to have to give it the number 3 ranking for now until I see what else is on this list. Coming in at purchase number 2, though, we have another popular dividend stock, but this time it's going to be in the energy sector with ExxonMobil, ticker symbol XOM, which Simons had previously sold down before now buying even more of the stock last quarter at almost a 200,000% increase up to over $450 million. But gotta be honest with you guys, this one doesn't look nearly as appealing to me because, first of all, Exxon is trading pretty close to an all-time high right now, and yet that's still only about 14% gains in the past decade, meaning that this is a very slow-moving stock here, and a pretty boring one at that, which I would say really relies almost entirely on oil and gas without the same type of growth opportunity or excitement that you might typically get from renewables. I'm not saying that petroleum will magically stop being needed, and to Exxon's defense, they are at least trying to diversify the business into more renewable areas and turn the company greener, especially in carbon capture, where they've spent billions of dollars acquiring companies, building facilities, and expanding projects that help them capture and store CO2 underground to help reduce the industrial emissions of their customers, which is all very interesting stuff, very interesting work. However, I still prefer companies with more pure play exposure to renewable energy, like NextEra Energy, for example, which is the largest producer of wind and solar in the entire world. Or even if I stick with another oil and gas giant, I would actually prefer Chevron instead, who is investing $10 billion through the next few years on green projects, including not just carbon capture, but also hydrogen, which could be another $1.4 trillion market opportunity by 2050, where Chevron already has the largest hydrogen storage plant in the entire world that both stores and uses it to produce electricity. On one hand, though, Exxon does at least have an attractive dividend, which is where investors would have to get most of their long-term gains from given the weak performing stock, as it yields 3.4% with over 4 decades of consecutive growth, meaning it's very reliable. But even their NextEra and Chevron both have higher yields of 3.5% and 4.2% respectively. Nothing against Exxon, but there's just other energy stocks that I happen to like more at the moment, especially NextEra Energy, who happens to also have a much better long-term performance in terms of the stock. But it is also currently down over 35% from the top, and I think that's looking like a great pickup at these lower levels. So I'm gonna have to just give Exxon the last place ranking here because of these few reasons that I just gave. Moving on to purchase number 3, though, we have one of the most popular and hotly debated stocks these days in Tesla, ticker symbol TSLA, which, like many people over the past year, Simons was selling out of pretty heavily before now deciding to more than triple his position on it last quarter, bringing it back up to over $634 million. And yeah, this is a very interesting bet here by Simons to jump back into it, considering all the issues that Tesla has been facing, which caused the stock to lose more than 60% of its value from the top, which even after that crash, it's still up almost 800% in the past 5 years, and it carries an extremely rich valuation because of it, trading anywhere from 1 to 300% higher than the sector on PE and PEG ratios. But the market has been rejecting Tesla because of that, as their growth is also slowing down now in the face of rising competition, where Tesla no longer benefits as heavily from that initial first mover's advantage that they used to rely on so heavily for explosive growth on both the top and bottom line. Nowadays, though, we not only have legacy automakers like GM, Ford, and Toyota pouring many billions of dollars into hybrid and electric technologies, but there's also a lot of competition coming from China as well. In fact, when talking about it in the last earnings call, Elon Musk actually praised Chinese car companies as being some of the most competitive in the world, noting that he thinks they'll have significant success even outside of China, going as far as to say that they will pretty much demolish most other car companies if trade barriers are not put in place. That's pretty crazy stuff, guys. Anyway, the result of all this rising competition has been a pricing war, both in China and outside of the country, which is forcing Tesla to cut prices, especially given our high interest rates that are weighing down consumers, at least here in America especially. And in turn, it's also sinking Tesla's margins right along with the stock price. However, the reason why I continue to hold on to my already very large Tesla position anyway is because I see this as really more of a cyclical downturn that can eventually be overcome. And there's two primary reasons why I feel this way. The first is the upcoming Tesla Model 2, or whatever they end up calling it, but it's basically their next gen vehicle platform that can sell at much lower prices with still pretty high margins at scale, because it'll basically be their mass market vehicle that is more easily attainable by customers. And that's why I think analysts expect a drop in EPS this year before a large rebound next year. But then reason number two is everything else that Tesla does, all the wild cards or the X factors that make Tesla special, make them a much larger, more diversified tech company than your typical automaker. I'm talking about the robotics, logistics, energy, battery storage, and of course autonomous driving, which I think can have the biggest margins of all, selling as primarily a software service, not to mention whatever else Tesla decides to really surprise us with in the future. But short term, I still think Tesla will continue to see pressure, resulting in a wildly volatile stock price that could be headed even lower. But longer term, it's one that I still want to be invested in for all of their future potential. So they take the number 2 ranking here because of it. I'm still a believer myself. That will, however, leave us now, though, with the final 2 purchases. These are the largest of the list. And coming in at number 4, it's going to be the giant Amazon, ticker symbol AMZN, which we've actually seen several big investors buying up recently. I've actually covered it in other videos, and I think that says a lot about just how good of a stock this is. But looking at the purchase here, like the others, Simons was actually selling out of Amazon in previous quarters before now deciding to buy back in, adding over $650 million worth just last quarter alone. Now, if we turn to the stock price, it's obviously been one of the best performers in history, up almost 1,000% in the past decade alone, although there was one giant dip there about a year ago where I loaded up on a ton of shares myself too. But even today, after the recovery, Amazon stock is still looking very attractive, at least in my opinion. Now, I won't rehash the things that I always say about them in so many of my videos, but just know that really there are no limits, I would say, to how big Amazon can become at this point, already dominating some of the biggest markets in the world like e-commerce and cloud computing, yet they're still growing sales by a double-digit rate in most years. And because Amazon never really cared about profits, they still carry some huge growth potential there on the bottom line, which is why their price to earnings to growth ratio is still pretty attractive to this day at just around 1.7. That's less than 13% higher than the sector median. And I think it makes for a solid buy here on Amazon. So I gave Amazon the number 1 ranking in last week's video when we looked at Citadel's purchases. And I'm going to give it the same ranking today too. It's one of my long time favorites. I will say though that the final purchase of the list is going to give Amazon a run for its money, because coming in as the largest here at number 5, It's actually another giant tech stock that I also own myself in Meta, ticker symbol META, which Simons added around 2 million shares of last quarter, bringing the stake up to around $750 million. And yeah, what's not to like about Meta these days? I mean, I know that they used to get hated on real heavily for all of the money that they were spending on the metaverse, and I even got a lot of criticism here on YouTube too for, saying that the stock was a buy the more that it kept crashing. And I'll be honest, there was even some times when I even started to question my own decisions too after seeing just how it really wouldn't stop falling the more that I kept purchasing it. And I was like, man, I hope that at some point it does turn around. But yeah, ultimately, I'm glad that I stuck with my long-term investing principles and didn't chicken out, because the stock did eventually skyrocket off of the bottom to now trading at an all-time high. And there's several reasons for that, which I also talked a lot about back then. But the main point of that was just really how insanely profitable Meta is, doing over $44 billion of free cash flow last year alone, with one of the absolute best balance sheets in the world, really good current and total ratios on it, which is all thanks to their massive user base of close to half the world's entire population using their apps. It's absolutely mind-blowing, which can also be used, by the way, to target the metaverse too. So I actually do agree with all of the investments that they poured into it. And because of that dominance and their investments into artificial intelligence, well, companies are still flooding in to advertise on their platforms with better ad targeting and tools than much of the competition, which is why Meta's ad business is not only growing faster than Google's right now, but it also makes up more than a fifth of all digital ad spending in America and more than 3/4 of it in social media too. So they're just absolutely on fire right now, with sales still growing by double digits, and even after the rise in stock price, their PEG ratio is actually still somehow cheaper than the sector by over 20%. I might give Amazon the very slight edge here just for how massively large and dominant they are and how they might, like one day end up running the world, but at today's prices, I would put Meta right up there with them, almost tied with Amazon. Still, this will give us our final rankings here, where I do give Amazon just a very slight edge at number 1, followed extremely closely by Meta at number 2. Tesla will take number 3 for being an expensive stock, but one that I do still believe in long term. And then I put Starbucks at number 4, who I think is okay to buy, but really not as exciting as the others. And then I put Exxon in last place at number 5, just because I'd rather buy something else like Next Era Energy or even Chevron instead. But in conclusion, I actually really like these pickups here by Simons. Now, I do strongly disagree with the selling that he did right before buying some of these. I'm a more long-term minded investor. I don't like to be moving in and out of stocks as frequently, but at least he did make some pretty large purchases here in this last quarter. And like I said, stocks, especially number 1 to number 3, I happen to really like those. And even number 4 is not that bad either. It's really just number 5 that I'm not a big fan of. But what do you all think? I'd love to hear your thoughts. Do you like or own any of these stocks? Do you agree with my ranking of them? Would you make any changes? And is there any other famous investor that you'd like me to review some of their stocks or purchases in the future too? I'd love to hear any suggestions, but thanks again for stopping by, my friends. I hope that you're all doing well, and I will catch you in the next video. All right, take care, everybody. Bye-bye.